Okay, this is the handout from Business 436, Understanding Financial Statements. The first part we'll do is the balance sheet. Basically, there's three primary financial statements: the balance sheet, the income statement, and the cash flow statement. And it's just so people can look at the financial structure of your firm and whatever financial leverage. And leverage has to do with how much debt you've got compared to the owner's equity. Okay, we'll go to the next page. Why financial statements? I mean, basically, a publicly traded company needs to have financial statements to disclose the required information so that investors can basically take a look at it. Again, there's three of them: the balance sheet, income statement, and cash flow statement. We'll look first at the balance sheet. The balance sheet, remember, is as of a period of time, and it's just a snapshot. It's not for like a month or year. It's showing at a certain date what your assets are, and they've got to equal your liabilities and owner's equity, if you remember that from accounting. Usually, this is on page 23 of the same thing. Usually, they prepare them at the end of the month, at the end of the quarter or fiscal year. Most of them are quarterly, especially for publicly held companies. Monthly is quite a bit. Remember, if you remember, and I sent you those charts too that I bought at Amazon, so you could take a look at those also. But assets equal the liabilities and the owner's equities. Okay, so the assets in the corporation are things like cash, raw materials, finished goods, lands, buildings, and equipment. Also something like accounts receivable, because that's an asset. That's something that you're owed, right? Whereas liabilities are different in that it's things that you owe to someone like a creditor. Accounts payable is a liability because you owe that to a supplier, right? If you borrow money from a bank or if you have a bond issue, anything like that is a liability because you owe that. And so if you have assets, things that are worth something like a building or cash or accounts receivable or equipment, and you subtract the liabilities, which are what you owe for like accounts payable or salaries owed or taxes owed, or if you owe bonds, you have to pay bonds off over a period of time, like monthly. That's called amortization. So if you take assets and subtract liabilities, you get what's called owner's equity, which is basically what the ownership of the business is worth. And just think about this as a house, right? The asset is the house structure itself. On a house, the liability is basically the mortgage, and the difference is your equity, right? That's a simplified version of a business, but that's, business has got a lot more different types of accounts and everything, but that's basically the same thing. The assets, the house, the liabilities, the mortgage, and the owner's equity is the equity in the house. Okay, that's what, if you sold that house, subtracting any closing costs, that's what you'd get. So it says owner's equity is also known as shareholders or stockholders' equity. It's what's left over after the liabilities are deducted from the assets. So assets minus liabilities equals owner's equities. Owner's equity. So that's what one of the things that people would be looking at for stock price. In this case, if there's $1 million in owner's equity and there's 1 million shares out there, the stock book value anyway would be worth $1 million. Okay, and that's on the balance sheet. These things have to balance. Assets have to equal liabilities plus owner's equity. Okay, the balance, but there's certain things that you could use the balance sheet for. It describes how much the company has invested in assets and shows where the money is invested. It also indicates how many of the monetary assets come from creditors. So if you've got some equipment or a building or land, but you've also got a lot of debt, and there's very little owner's equity, then you have what's called a high debt to equity ratio. Say in a company that you had $1 million in debt and only 100,000 left in equity, then that's a pretty high debt to equity ratio. So if someone's looking to lend you money, they're probably not going to lend you money, or they're going to lend it at a much higher rate because of that. So if you think about the equation, assets equals liabilities plus owner equities, if you've got a certain amount of assets and your liabilities goes up, it has to come out of the owner's equity. So that the lower the owner's equity, the higher the debt, the more risky the company looks because of a debt to equity ratio. And it says that it's most balance sheets are most helpful when you look at them compared to previous years, because that tells you the trends, right? So assets, there's different types of assets. There's current assets, generally things that can be converted to cash within 1 year. And it says the balance sheet tallies other assets that are tougher to convert. For example, buildings and equipment. These are called fixed assets. And it says because most assets except land depreciate, there's also something called accumulated depreciation. Here's showing the balance sheet of this company called Amalgamated. This is on page 25. We'll get back to that. But basically, it says these assets that this talk about depreciation. These assets depreciate. It's called into account called accumulated depreciation. Gross property, plant, and equipment minus accumulated depreciation equals the current book value. I don't know if you remember that from accounting. So if you remember when you buy like equipment, it has to be put on the books at what it costs. It's historic cost. And then you've got accumulated depreciation, say every year. So whatever that accumulated depreciation account is, you take the historic costs, which the asset is carried at, subtract the accumulated depreciation, and that's what you get the book value of that property, plant, or equipment. There's also another asset called goodwill. If you bought a company like Apple, it's got such a good name that it sells for more than its book value just because it's got a good name, or it might even have patents, which can be considered goodwill, I guess. So finally, we come to the list of the assets section of the balance sheet. Total assets. Total assets represent the sum of current and fixed assets. Okay, now they talk about liabilities. This has to do with just the balance sheet, remember? Okay, so you have current liabilities just like you have current assets. And that represents the claims of creditors that must be paid within a year, just like current assets are something that can be converted to cash within a year. So that could be short-term IOUs, accrued salaries, accrued income taxes, accounts payable, all things which you'd pay within a year. These are liabilities now. Subtracting current liabilities from current assets gives you the company's net working capital. So if you have, just use a simple example, say we were an all-cash business. So if you had your cash minus your accounts payable, that would be your current or your net working capital. Okay, and that's just stuff that you can convert to cash and stuff within a year, and stuff that you have to pay within a year. So that's saying that's what your net working capital is. Okay, and it has to do with short-term activities. It is talking about an Amalgamated had $868,000 in net working capital. If you look back at the balance sheet, we'll look back at it in just a second. Long-term liabilities are typically things like bonds and mortgages and debts like that. We are paying them off over time. So thus, subtracting total liabilities from total assets, the balance sheet arrives at a figure called owner's equity. So if you got your total assets, remember your total assets have to equal your liabilities plus your owner's equity. So assets minus liabilities would be what the owner's equity is. So say 1 year you had $1 million in assets and you had $5,000 in liabilities, the owner's equity would be $500,000. But the next year you had $1 million assets and now you got $800,000 in liabilities. Say you borrowed $300,000 more money. Now, where does that come out of? Logically, it comes out of the owner's equity, which is what the owner's share of the business is worth. Okay. And also it talks about retained earnings. It says, thus, detracting total liabilities from total asset, the balance sheet arrives at a figure called owner's equity. Owner equity comprises retained earnings, which, remember, net profits roll into the retained earnings of a business, but net profits accumulate on a company's balance sheet after any dividends are paid. A dividend distribution is going to the owners, so that comes out of owner's equity. And capital contributed in exchange for shares. So if owners bought more shares, then that would be more contributed capital, which that contributed capital increases the owner's equity. So say someone bought 100,000 more shares that had not been issued before. So now they're at $1 each. So now there's $100,000 in capital that goes into the company, and that goes in as owner's equity. It goes into the cash on one side, and the as a debit, and credit as owner's equity. Okay. Talks about historical values. Except for items such as cash, accounts receivable, accounts payable, the measurement of each classification will rarely be equal to the actual current or cash value. What they mean is, except for certain things like cash is worth what cash is. Your accounts receivable and your accounts payable are pretty much going to be worth what they are. But a lot of other stuff won't. For instance, if a company owns some property that they bought 30 years ago, since you have to use the purchase price, the historical value on the books, then if they bought it 20 years ago and now it's worth 3 times as much, it'll still show on the book. As in this case, they talk about land purchased in San Francisco in 1960 at $700,000. What's still on the books as being worth $700,000. It's not worth $700,000. So some of the historical values are off by quite a bit compared to what their current value is. The reason they do that, though, is because it would be too hard to go through every single year and get everything appraised, your plant, your equipment, your inventory. For instance, if you are a computer company, computers go down in value so quickly, like personal computers, that you'd have to mark them down every quarter. So that's why they keep assets on the book at like plant and equipment and all that, at its purchase price, its historical value. Okay, and then it talks about working capital. Business owners give substantial attention to the level of working capital. Remember, working capital, we talked about that earlier. Current assets minus current liabilities is net working capital. That's the stuff that you owe within a year that you got to pay in cash, and the stuff that you can convert to cash within a year, net working capital. Obviously, that's important because typically you have to pay, you have to pay the bills, and you've got to have net working capital to do it. Okay, an inventory is one component of working capital. We're at the top of page 28. Because your inventory, typically, you better be converting it within a year to cash, right? So if you tie too much in inventory, you've tied up too much. There's a balance on inventory because you got to have enough inventory so you can sell to your customers, right? But if you've got too much, you're tying up working capital because it's just sitting there. Inventory has a cost to it. You've spent money to make that inventory. So that you've got to strike a balance in what your inventory is. Like they talk about personal computers, they plan on that every day personal computer company that a personal computer is worth 2% less in inventory because of obsolescence. Okay, then they talk about financial leverage. Again, this is what balance sheets help you look at. Financial leverage is basically the more leverage you have, and leverage in the term of debt, the more you can make or lose on your as a percentage of return on your investment. So, for instance, this says financial leverage refers to the use of borrowed money in acquiring an asset. We say that a company is highly leveraged when the percentage of debt on its balance sheet is high relative to the capital invested by owners. A high debt to equity ratio, how much debt the company has versus its equity. This is how much the owners owe as a part of the company. This is how much is owed to creditors. So the higher the debt, the higher the creditors are owed is a percentage of the debt to equity ratio. Okay? So they talk about, for example, suppose you'd paid 400,000 for an asset using 100,000 of your own money and had borrowed 300,000. Okay? So if that goes, you only invested 100,000, you borrowed 300,000. So they're trying to show you how financial leverage works. Okay, if the price of that asset goes up to 500,000, now you've made $100,000 on your 100,000, so 100%. But if you had bought an asset for 400,000 and you had paid cash 400,000 and it went up 100,000, now you've made 100,000 on 400,000 that you invested, so it's a 25% return. You got the same amount of money, but you invested a lot more money to get that same return. And this is not taking into account, loan payments or taxes or any of that stuff. But that's leverage, but it can also work in the opposite direction. Okay, let's say that same asset you paid 400,000 for and borrowed 300,000, and it dropped to 300,000. You invested $100,000. Now your whole investment is wiped out. You lost $100,000, so you lost 100%. But if you'd paid cash for that $400,000 investment and it went down to 300,000, you still lost the same 100,000, but you only lost 25% of your investment. So leverage works both ways. And also what happens is the higher debt to equity ratio, that means that, remember, the equity is what percent of the business the owners still own. And so banks use the equity part of a business for collateral, just as the same on the house. So if there's very little equity in a business, these guys probably aren't going to loan you money, because what can they collateralize their loan against if there's nothing there? So and if they do, say you've got a moderately high debt to equity ratio, then they're going to charge you a higher interest rate anyway versus someone that has a low debt to equity ratio. So that's another thing that balance sheets are used to look at. Okay, so this just goes through and talks about the same thing that I was just talking about, the debt to equity ratio, and how your bonds can be priced higher the higher the debt to equity ratio. Excuse me, not priced higher. You pay a higher rate of return to the investor, which is costing you more in interest expense, right? Okay, so we'll take a look at the balance sheet. Example that they give. Okay, for amalgamated hat rack, and see, here's the assets: cash and marketable securities, accounts receivable, inventory, prepaid expenses. These are current assets. Prepaid expenses are like if you prepaid rent. Remember, that's still an asset to you, and that's a current asset because you'll be using that up. There's something like prepaid rent. If you paid rent 3 months in advance, you'll be using that up monthly. So remember, current assets are something that can be converted to cash within the first year. So this balance sheet is showing the changes between 2002 and 2001. These are long-term assets like gross property, plant, and equipment. And then you've got the accumulated depreciation for that property and plant and equipment. So remember, if you take for instance, if you take a piece of equipment, subtract its accumulated depreciation, that gives you the book value. Maybe not really the current market value, but the book value. And so it says net property, plant, and equipment, which is the property, plant, and equipment minus accumulated depreciation. That's your long-term assets. So you add these two together, you add this and this together, get your total assets. Same with liabilities. Short-term liabilities, they call them current liabilities. Accounts payable, accrued expenses, income tax payable, short-term debt. That's short-term debt. Okay, so that gives you your total current liabilities. Then you take your long-term debt. That gives you your total liabilities. Okay, so remember, assets have to equal liabilities and owner's equity. So the difference between the assets total assets and the total liabilities will have to equal the owner's equity. And if you have retained earnings or contributed capital or something, these two have to work out to make total owner's equity plus total liabilities equal total assets. The total liabilities and owner's equity equals total assets. So you can't change what your long-term debt is. You can't change any of these things. So what happens is if your total liabilities go up, then your owner's equity, which is what you owe the company, goes down, right? Oh, I'm sorry, I should be showing you this stuff. Okay, so you got the long-term debt. I've been showing this stuff and not having it on the page. Okay, so your total liabilities and owner's equity has to equal your total assets. You've got your total current liabilities and your long-term liabilities. Those are what they are. Okay, so the difference, because remember, the liabilities plus your owner's equity, which is that amount, has to equal your total assets. So the difference is going to come out of the owner's equity. So if your liabilities went up way up for a year, then your owner's equity is going to go down, to make sure that it matches this number. From year to year, I'm saying. Okay, so just remember that. If everything else stayed the same year to year, except that your liability, so if your assets stayed the same from one year to the next, your liabilities went up, you know that your owner's equity went down, which is your ownership of the company, and that makes sense because it's worth less. Basically, the owner's equity is what that is worth to you. Think about it as a home, just real quick again. If the value of your home went up and your mortgage stayed the same, then your equity got bigger. But if the value of your home went down and your mortgage stayed the same, then your equity went down. So the equity is the part that would change if everything else remained the same, or it has to make up for the difference between the total assets and the total liabilities. Okay? So that's the part on the balance sheet. I'll do the income statement and cash flow separately.